Lessons from history. History offers some of the clearest insights into gold's role in finance. Again and again, during major economic shifts, gold has returned to the center of the system. It has financed governments, stabilized currencies, and influenced global trade. Its importance rises during uncertainty, wars, depressions, inflation, and financial crises. This pattern repeats across centuries, showing that gold is not simply a commodity. It is a strategic asset that societies turn to when stability is threatened. Key historical events. Several key moments illustrate this. The Gold Reserve Act of 1934 centralized gold under U.S. government control, strengthening national reserves during the Great Depression. The Bretton Woods system linked global currencies to the dollar and the dollar to gold, creating decades of relative stability in exchange rates. Then came the Nixon shock in 1971, ending convertibility and ushering in the modern fiat era. Afterward, inflation surged until strong monetary policies eventually stabilized prices. Each of these events reshaped the global financial order, and gold was at the center of every transition. Gold in crises. One lesson stands out clearly. During crises, gold reappears as a stabilizing force. It acts as a reserve, a hedge, and a psychological anchor. Investors trust it because it is not tied to a single government or currency. Central banks hold it for the same reason. It provides independence and credibility. Across generations, gold has maintained that reputation, and while financial systems evolve, this core behavior remains constant. When uncertainty rises, attention returns to gold. Modern gold scenarios. If gold were to play a larger role in the future monetary system, it would not necessarily look like the past. Economists and policymakers have proposed several modern scenarios. One idea is to use gold as a reference indicator, not as a currency itself, but as a benchmark for inflation and stability. Another concept is a Bretton Woods 2.0, where global financial systems integrate gold into a new framework alongside digital settlements. There are also models where countries could adopt domestic gold-linked pricing systems while maintaining flexible exchange rates internationally. And in more market-driven visions, gold-backed financial instruments could compete directly with fiat currencies. Each scenario reflects a different balance between control, flexibility, and stability. Digital era integration. Today's financial world is fundamentally digital. Payments, settlements, and transactions occur instantly across borders. This opens the door for hybrid systems where gold and digital currencies coexist. Central bank digital currencies, stablecoins, and blockchain infrastructure could operate alongside physical reserves. In this layered system, gold might serve as the ultimate reserve asset, while digital tools handle daily transactions. This combination allows efficiency without losing a long-term anchor of value. The future may not be gold versus technology, but gold with technology. Policy challenges. However, implementing such systems would not be simple. Political resistance would be significant. Governments may hesitate to limit monetary flexibility. Financial institutions would need new regulations and infrastructure, and economies would need to adapt to new risk structures. Any move toward gold would involve trade-offs: stability versus flexibility, discipline versus control. The discussion is not just technical, it is deeply political. Money is power, and changing its foundation changes how that power is distributed. Operational challenges. Even if societies decided to move toward a stronger gold-based system, the practical challenges would be enormous. First, there is no universal answer to how much gold is enough. Different economies have different sizes, needs, and monetary structures. A fixed system would also require adjustments through wages and prices rather than through currency depreciation. That can create economic rigidity, especially during recessions. The idea may sound simple in theory, but in practice it requires complex balancing. Geopolitical factors. Gold is not only financial, it is geographic. Physical reserves are stored in specific locations, often in a few major financial centers. Access, control, and political relations become critical. International tensions could influence who holds reserves and who can access them. This makes gold part of global power dynamics. A gold-based system would not eliminate geopolitics. It would likely intensify it. Countries would compete not just for economic influence, but for physical reserves, transparency and costs. Another major issue is transparency. Modern financial systems require trust, and trust requires verification. Auditing reserves, maintaining security, and building infrastructure would all come with costs. Technically, transitioning toward a stronger gold framework may be possible, but politically and economically it would be challenging. The gap between what is technically feasible and what is realistically achievable remains one of the biggest barriers. Gold may be simple as a metal, but complex as a system. Historical case studies. History gives us valuable insight into what happens when societies try to reconnect money with gold. One well-known example comes from Winston Churchill in 1925. When Britain attempted to return to the gold standard at its pre-war exchange rate, the move was symbolically powerful but economically painful, leading to deflation and pressure on wages and employment. Decades later, in the early 1980s, the Reagan Gold Commission in the United States explored the possibility of restoring a gold-based system. After extensive analysis, the proposal was ultimately rejected, not because gold lacked value, but because the transition would have been politically and economically difficult. These cases show that gold has never disappeared from the conversation. It continues to return whenever monetary stability is questioned. Impact on society. A gold-based system would affect every level of society. For households, it could mean stronger long-term purchasing power and protection against inflation. But it could also bring sharper adjustments during recessions, as prices and wages would need to respond more directly. For businesses, reduced currency volatility could improve planning and international trade, but tighter credit conditions might limit expansion. Governments would face stronger fiscal discipline, with fewer options to create money during emergencies. And global trade could become more stable, yet more competitive, as countries manage physical reserves. Economic trade-offs. No monetary system is perfect. A stronger gold role could reduce inflation risks but limit flexibility. Credit cycles might become less extreme, but financing growth could be harder. Economic adjustments could become slower and more visible. Policymakers would lose certain tools while gaining others. The key idea is balance. Gold introduces discipline, but discipline always comes with constraints. The challenge is finding a system that preserves stability without blocking growth. Future role of gold. Looking forward, it is unlikely that the world will simply return to a 19th century gold standard. The modern financial system is too complex, too global, and too digital. But gold could still play a central role, just in a different form. Many experts envision hybrid systems, where gold functions as a reserve core while digital currencies handle transactions. In this scenario, gold would not replace money, it would stabilize it. Its presence would signal discipline, credibility, and long-term value. Message for investors. For investors, the message is already visible. Central banks continue accumulating gold reserves. Policymakers still reference gold during discussions about stability. Financial markets treat it as a safe haven in times of uncertainty. Gold has not disappeared and it has adapted. It no longer defines everyday transactions, but it remains an anchor beneath the system. This is why many long-term investors view gold not as speculation, but as protection. Final perspective. Ultimately, gold's importance is not about price alone. It represents trust across time. It connects past monetary systems with future financial innovations. It reminds us that value is not only created by policy or technology, but also by scarcity and credibility. In a world of rapid change, gold remains constant, not as a relic, but as a reference point, a golden compass guiding financial thinking in uncertain times.